Tyson made over $400 million during his legendary boxing career, but by 2003, he had lost everything, declaring bankruptcy with $23 million in crushing debt. Contrast that with Ronald Read. He spent 25 years fixing cars at a gas station and another 17 sweeping floors as a janitor. When he died in 2014, he left behind an $8 million fortune. You don't see this happen in medicine or engineering. A person with no medical training cannot walk into an operating room and perform open-heart surgery better than a Harvard-trained surgeon. But in finance, a janitor with no formal education can vastly outperform the brightest minds on Wall Street. We are taught to view money as a math problem. We look for formulas, interest rates, and data, assuming financial success requires a genius-level IQ and a perfect spreadsheet. The math does not matter if you panic during a market drop or spend everything you earn. Your wealth depends almost entirely on how you behave. Once you understand the psychological traps designed to keep you poor, anyone can master the game. When a bright red Ferrari drives down the street, you rarely look at the person behind the wheel. You look at the car, and you imagine yourself driving it, assuming people would give you respect and admiration. This is the man in the car paradox. People buy luxury objects to prove their worth, completely ignoring the fact that everyone else is ignoring the driver and admiring the object. Building an impressive bank account often requires ignoring what others think of you. Your savings rate is simply the gap between your income and your ego. Buying things specifically to show people how much money you have is the fastest way to guarantee you'll have less of it. This infographic illustrates the core difference between being rich and being wealthy. The visible tip of the iceberg represents the rich. They spend their current income on status symbols you can easily see: houses, cars, designer clothes. But true wealth sits below the surface. Wealth is the financial assets that have not been converted into stuff. It is the unspent money, the unbought luxuries, the investments quietly growing in the background. By choosing to keep your money invisible, you shield your financial future from the unwinnable trap of constantly comparing yourself to your neighbors. Warren Buffett is universally recognized as one of the greatest investors alive, sitting on a net worth of well over $100 billion. Yet 99% of that wealth was generated after his 50th birthday. This chart demonstrates the mechanics of compounding. Notice how the line stays almost entirely flat for years or decades. You earn interest on your initial investment, and then you earn interest on that interest. It feels painfully slow at first, eventually accelerating into exponential growth. Buffett started investing when he was 10 years old. His secret was not finding the highest possible returns. It was maintaining a steady, average return and refusing to interrupt it for over 3/4 of a century.
Patience is the ultimate financial strategy. Staying invested over decades mathematically defeats the urge to jump in and out, trying to perfectly time the market's peaks and valleys. Getting wealthy requires a totally different set of skills than staying wealthy. Getting there requires taking risks, being optimistic, and playing offense. Staying there demands defense, a healthy dose of paranoia, extreme humility, and the acceptance that what you've built can be taken away. When your portfolio drops 20% in a single month, it feels like a fine. It feels like you made a mistake and the market is punishing you. But it is actually a fee. The emotional pain of volatility is simply the price of admission for long-term gains. Over a 75-year investing lifetime, massive systemic shocks will hit. Recessions, bank collapses, and global panics are historically inevitable. You have to assume the market will break. This is why you need a margin of safety. If you over-leverage your investments or fail to keep enough cash in reserve, a sudden downturn will force you to sell your assets at the absolute worst time just to survive. Your returns don't matter if a single panic wipe out your capital. The ability to emotionally withstand terror and hold your positions is the dividing line between those who reap compounding rewards and those losing everything. If true wealth is hidden and you have to wait 30 years for compounding to do its heavy lifting, what is the actual point of saving your money? It buys you a psychological safety net. Building an FU fund gives you options. It gives you the ability to walk away from a terrible boss, a toxic work environment, or a city you hate, without wondering how you will pay rent next month. The absolute highest dividend money pays is the ability to wake up every morning and say, I can do whatever I want today. It gives you total control over your own schedule and your own choices.
A person earning 6 figures but drowning in expenses is trapped. They must endure 70-hour work weeks and endless stress because quitting is impossible. Someone earning half that amount, who keeps their expenses low and saves aggressively, possesses the true power to leave whenever they choose. Humans have a dangerous habit of moving the goalposts. You hit your target, buy the house, get the promotion, and immediately look towards the next one. The pursuit of more turns into an endless treadmill, where satisfaction is always just out of reach. To step off the treadmill, you have to define what enough means to you. Look at Sam Bankman-Fried. At 29, he was worth over $20 billion. He had already won the game. But because he lacked a definition of enough, he took reckless, illegal risks chasing higher status, losing absolutely everything in the process. Money is not the final destination. Freedom, peace, and total control over your life, that is the real wealth.